Hello, this is Mark Pruitt with Strategic Estate Planning Services, and today I want to talk to you about something that's on a lot of people's minds as we head into the end of the year. How elections can affect the stock market, specifically the S&P 500. You know, with all the noise surrounding the political events, it's easy to feel uncertain about the investments. But let's take a step back and look at the bigger picture. Historically, the S&P 500 from September to December in the last 7 election cycles has varied, sometimes significantly. So let's look at some data from the last 7 U.S. presidential election years to give you a clearer perspective. In 2020, the S&P 500 gained about 11.7%. This was largely driven by expectations of economic recovery post-pandemic and the election results. 2016 also saw a solid gain of about 5% as markets reacted positively to the anticipated policies of the new administration. Now, going back to 2012, we saw a similar trend with an increase of 11.2%, supported by economic optimism. However, not every election year is rosy. In 2008, during the height of the financial crisis, the S&P 500 declined by a substantial 21.4%. And the global financial meltdown overshadowed the election, but it's important to remember that this wasn't due to the election itself. It was part of a larger economic event. Now, in 2004, we saw more typical gain of 7.6% given by economic growth and a favorable market response to the election. In 2000, that was a bit more subdued with only 0.9% increase. That year's volatility was influenced by the tech bubble and the contested election results. And back in 1996, we saw a strong 7% gain with a stable economy and a predictable election outcome that gave investors confidence. So what does all this mean for you as an investor? Well, these historical trends show us that while markets do react to elections, they are also influenced by a wide range of factors, like the overall economy, global events, and even technological changes. And a lot of what drives the market performance is beyond election outcomes. So it's easy to get caught up in the headlines of today. But remember, elections are just one piece of the puzzle. And history shows that markets tend to recover from periods of volatility. And in most cases, they've ended up the year in positive territory. You know, even in the challenging 2008, those who stayed patient saw recovery in the following years. The key takeaway here is that while short-term volatility can happen, staying focused on your long-term goals and not letting emotions drive decisions is critical. Markets may fluctuate during election years, but they tend to reward patient, disciplined investors over time. So whether it's managing your portfolio, adjusting your risk tolerance, or simply riding out temporary uncertainty, we're here to guide you through it. Staying diversified, reviewing your financial plan, and making sure you have solid strategy in place are important ways to weather any storm, including election year jitters. So if you have any concerns or questions, I'm always here to help. Feel free to reach out and let's review that you're on the right track no matter what happens in the political world. Thank you for watching, and remember, stay calm, stay informed, and when it comes to your money, it pays to be strategic.